Howdy, folks. Jeff Camarda. It is Tuesday, April 22nd, with your continuing COVID crisis, market, and other financial matters update. Sorry if I'm hamming it up a little bit here. Not a whole lot of change in the markets. Oil has rebounded, still giving it away, but not negative depending on the month for delivery of the physical product. Markets are still in turmoil. We had an up day, a modest up day on the U.S. markets today after 3 down days. And again, that a trend does not make, in my view. I think we're still pretty much in crisis, and I'm concerned about another down leg. But hopefully the worst is past. We'll wait and see, again, how the market reacts to the continuing stream of earnings and other economic news as released. I wanted to give you a bit of an update on the AIMS portfolios. And again, we have, depending on the investment style, from riskiest to most conservative of AIMS, which stands, by the way, for Allocated Investment Management System, gone largely to cash. So in the offshore version of AIMS, we're at about 87% cash now. Capital appreciation, about 78%. Stabilized growth, about 74%. Balanced or moderate portfolio, about 60% cash. Conservative, about 58% cash, and integrated income, about half in cash. And the reason for more in cash, more aggressive portfolios is because those had components that were more at risk, more stocks and so forth. As we get more conservative going to integrated income, we're already in fairly safe things, so there wasn't as much to liquidate in order to execute our structured liquidity directive. The other thing I wanted to mention, so again, we're happy to be there. We're poised to jump if it appears opportune. But I feel very comfortable having such large cash positions. Caesar, I think, is about 60-65% cash as well, by the way. And give me 1 second to change spreadsheets here. As we look at the sectors, which I told you, I think yesterday, that we think healthcare and consumer defensive, cereal, not travel, consumer, not discretionary, but staples, things that consumers buy pretty much regardless of the state of the economy, like toilet paper. Consumer defensive, technology, communication services, and utilities are favored sectors. We also, I had to bite my tongue to say this, but for non-U.S. economies, think that China and India, is there some conspiracy to bolster the Chinese economy? I'm not going to go there, but we think that those economies will do relatively better than other non-U.S. economies like Europe. So our non-U.S. efforts, which will be far truncated from what we've done in the past, will be focused there. As far as safer components, obviously cash, money market funds, short government bonds, ultra short corporate bonds, short-term corporate bonds, maybe intermediate-term bonds. We're still deliberating over that. Utilities, as mentioned, managed futures, which it's a fairly esoteric structured product, but basically managed futures funds are hedge portfolios that look for, that target relatively low and safe rates of return, and the safety comes from hedging, and other components of the engineered portfolio, such as if one goes down, something else goes up, and it kind of balances out. So we're looking at that sort of a futures fund really as a conservative product. And also we're toying with the idea of gold, which, as you know, is a haven at times of frights and economic strife. Folks tend to like gold, and it's been, gold has done well in the recent turmoil. So that's what the palette looks like for the new AIMS. We're currently going through the selection process. There are hundreds, if not thousands, of mutual funds and ETFs that match the sector choices. So we're going to kind of parse through those and find the ones that we like best. But that's pretty much on the investment and economic update. I do want to spend a couple of moments on trusts, basically, and try to use these videos as the opportunities to provide some financial education. So a trust base, and many of you have them, and many more should have them, but don't, so you might want to think about it. But a trust basically is a vehicle. Think of it as a bucket that holds assets. And there are 3 basic parties to a trust. There's a so-called grantor or donor. That's the person that puts the property, the assets, into the bucket. Then there's the trustee. That's the person or company or whatever that is the manager of the assets in the bucket. And then there's the beneficiary, which is the person or people for whom the assets in the bucket are managed, right? So you have the person that puts it in, the person that runs it, and the person that gets the benefit from it. And often, for those of you that are clients, these are all the same people, right? So Kim and I are sitting across the desk from me now, or John and Mary, Q clients. John and Mary they put their assets in. They're the trustees during their lifetime, and it's administered for their benefit, right? So it's the same people. So why use a trust? There's a lot of reasons, but the basic, simpler reasons are, number one, it avoids probate. It's kind of a will substitute, and that's cool for two reasons. Number one, it's private. Probate's a public process, so your estranged relatives that might contest the will are going to be able to see the assets controlled by your will, but not in a trust. A trust is private. The second thing is it avoids probate, which can be an expensive and arduous and painful process. And also it, forgive me, that's my phone. I'm going to turn that off. It also is, so you avoid the significant probate expenses. And also in the event that John and Mary have cognitive issues down the road, Alzheimer's or whatever, it provides a seamless transfer of control or leadership to their kids or whoever they want to have as the successor trustees, which is also really important to avoid something called guardianship, which is if John and Mary get Alzheimer's and they can't pay their bills and so forth, and there's no mechanism set up like a trust or powers of attorney, then a judge has to decide who's going to be the guardian and write the checks. It's messy, it's expensive. The guardian doesn't have to be your child. It can be the judge's cousin. There's a whole lot of hair on the guardianship deal. Trusts are a much more elegant solution. So that pretty much is the basics. I'm sure there are a lot of other reasons to use them, but that's the framework for why most people, most of you watching, should have a trust, and probably should tune it up if it hasn't been reviewed by a competent attorney lately, to make sure that it suits your goals and what existing law is. Okay, so again, it's a simple thing. It's kind of like a company, but not. But the trust is a bucket. You put the assets in the bucket. You're the donor, the person in, for the benefit of who? Yourself, and then probably your kids. And then who gets to run the assets in the bucket? The trustee. And again, that's you, so long as you can. And then usually it's going to be your kids or some other trusted relative. And by the way, virtually all the trusts we work with are so-called revocable, which means you can change your mind, dissolve the trust, take the assets out, go out and buy a Ferrari or yacht, whatever you want with it. So it's a completely malleable, changeable structure. You're not stuck with it once it's in there. And I'm sure I've droned on far too long for today. So take my best wishes for this Tuesday evening. And hopefully we'll have more. We'll definitely have more good cheer for you tomorrow, and hopefully some good news as well. Jeff Camarda signing out for today. See you Wednesday. Bye.